On a hideous day for the averages, what managed to buck the trend? Well, last night, Match Group, the online dating colossus behind Tinder, Match.com, OkCupid, reported a blowout quarter, and its stock caught fire. That strength spread to Match's parent company, IAC, which I like to call the most ubiquitous company that most people have never heard of. Think of IAC as a house of digital brands put together by the legendary Barry Diller. They own Ask.com, Dotdash, Vimeo, The Daily Beast, just to name a handful of their properties. More importantly, IAC has a controlling interest in two publicly traded subsidiaries, the aforementioned Match Group, on fire, and Angie Home Services, which was created when they combined Angie's List with Home Advisor. Now, tonight we heard from both Angie Home Services, which posted an okay number, a big buyback, and IAC itself, which gave us a solid quarter, a nice top-line beat with higher-than-expected earnings before interest, taxes, depreciation, amortization, which is the key metric here. But I think the real story, frankly, is that IAC stock remains absurdly cheap on what we call an SOTP, or sum of the parts basis, even as it's more than doubled since I recommended it in June of 2017. The company owns 81% of Match Group and 84% of Angie Home Services. However, these positions are worth $19.7 billion, yet the market values IAC at roughly $18 billion. That's lunacy. The whole should not be worth less than the sum of the parts, particularly when there's a lot besides those two companies. Don't take it from me, though. Earlier today, we sat down with Joey Levin. He's the CEO of IAC. Learn more about the quarter and his house of brands. Take a look. Okay, Joey, I know you watch the show. We cannot figure out, it's a great conundrum, how come this company isn't valued substantially higher given the sum of the parts? It's your first time on the show. Just run through all these incredible values and how you get them with IAC.
Sure. We have two public companies underneath IAC, so we own public shares in Match Group, which is worth, I don't know, today they're up a bit. Match
on a terrible day. It was one of the few that I followed was up.
It was a good day. And that's worth roughly, I don't know, $12 billion or something like that. We have shares in Angie Home Services, another public company. We also own 85% of that. That's worth another $6 or $7 billion. And then we have cash on our balance sheet. We have, just at the parent company, IAC, we have $1.7 billion of cash. And when you add all that up, it usually adds up to something more than our current market cap.
And it's not just a loan. There's dividends that you've given. There's also companies
and we have lots of companies beyond that.
Right.
We have Vimeo, which is a private company. That's all subsumed in IAC. We have Dotdash, which is a publishing business, which is doing very well. We have a mobile applications business that's growing phenomenally well. I think it grew up something like 100% in the last quarter. Profitable. It's pretty amazing.
I want to talk about Vimeo for a second.
Yeah.
It's a platform. And therefore, it's completely undervalued within this company. Could Vimeo one day be spun out like a Match or an Angie's?
I hope so. I mean, look, we don't. There's no timeline on those things, but I hope so. That's the goal in all of these businesses. That's what we tell the leadership. That's what we try and organize for. Is you want to be big enough, strong enough, sturdy enough in a big enough market that it makes sense to stand on its own.
I've known quite a few people come through your company and some executives, some leadership people, and they've always felt that it was the classic way incubators were supposed to be. That you got money to do what was great. If you operated really well, then there was lots of rewards. I mean, it seems to me like the ultimate meritocratic capitalist institution.
It really is. It's focused on, it has nothing to do with where you come from, even what your experience is, what your age is. I've been a beneficiary of that, as have others. It's about what you're excited about, what you're passionate about, and if you are, you get the opportunity, and you learn on the job.
Well, can some of that be just the ethos of Barry Diller? I mean, he's always been someone who wants to champion people who do well.
Yeah, he wants to give people a chance, and he has always been motivated by big opportunities and finding people's passions. And when you find that, you invest behind it.
When I was doing some research on the company, I was staggered to see how much better you have done over the last 3 years than FANG. And it just seems odd because we all think of FANG as just this tremendous juggernaut. But IAC is just quietly, I mean, it's doubled since we profiled it.
Yeah, look. FANG is a tremendous juggernaut, and those are some phenomenal businesses in there. I mean, truly phenomenal businesses in there. But we judge ourselves on ourselves, and we got to grow our businesses, and we've been fortunate to have each of our businesses really in the last year in a way we'd never seen before. Each of our businesses individually growing, and each of them still single-digit penetrated in huge markets. So take Angie Home Services. It's a $400 billion market, and we have single-digit penetration in there and a lead a pretty substantial lead relative to the next.
Now, how much cyclicality does that company have? Because I know that you always blow away the estimates for Match. I am concerned that Angie's in a real housing downturn maybe gets hurt, or is it really countercyclical?
We have a decent belief that it can be countercyclical. So when you think about when housing goes down, people move less, they stay in their homes longer. That means they're doing more work on their homes, number one. But number two, what that also means is that the service professionals are more interested in getting business from our platform because they're not inundated with business that's coming in everywhere. So there is some countercyclicality in that, but also 2/3 of our business is non-discretionary. So when you're locked out of your house, you're not waiting for the economy to turn to get back in. If your garage door isn't opening, you're not waiting for the economy.
Now, there are a couple of companies that are buried in that I want to ask you about. I happen to care passionately about financial literacy. You own Investopedia. Sure. The millennials want and are desperate for financial literacy. Can you blow that company out somehow?
We're definitely trying, and we definitely share that passion. It is amazing how few people are prepared for retirement. It is amazing how little people understand the importance of compounding capital and starting that early in your career.
Right.
And that's one of our goals at Investopedia for sure, among many.
Okay, now I don't want to steal anyone's fire, but we had the CEO of Match on, but I think Match is an amazing company.
Me too.
I think there's ahead of Valentine's Day. It's obviously good. I would talk about another side of it, but it's an amazing percentage, algorithmic percentage of people who end up meeting each other and marrying. But it also seems to be for people who are lonely that aren't looking for anything other than people to spend some time with.
Look, meeting new people is a really hard thing. For any purpose, meeting new people is a really hard thing. That first interaction with anybody is awkward. And one of the things that digital platforms can do is they can break down those barriers because you don't know whether a person standing next to you is interested in meeting new people. And if you want to cross that barrier, that could be a awkward thing. But when you're on a platform where everybody on the platform said, I'm interested in meeting new people, that certainly makes it a lot easier to interact.
Okay, so also we are huge believers in the subscription economy, which is why we first profiled you.
Us too.
It's sticky, right? And also you do tier. I mean, it's really one of the most continuing generation of income of any company I know.
Yeah, look, we've been in love with the subscription model for a very long time.
Before everybody else.
I don't know. But
the more I think about it, there aren't many that knew about it.
Yeah, look, the great thing about a subscription model, and especially in times like these with things that people are talking about, is the value exchange to a consumer is crystal clear. When you start talking about data and free models and advertising, the value exchange starts to get a little bit cloudy for consumers. Our value is crystal clear. You pay X, you get Y.
One last question, Joe. I mean, should we just say it's always going to have a discount just because it's difficult to value, or is it one day we're going to have a magic wand and we're going to see the stock up 30 points and that you got to get in ahead of it?
Well, look, I'd love to have that magic wand, but I think any multi-business business, there are reasons that investors give them a discount. They think they'll never get access to the cash flow. Right. We have a history of repurchasing shares. We have a history of paying dividends, things like that. So we generally, I think, should get credit for that. People say, well, if we do get access to the companies directly, we're going to have to pay taxes. We've done a number of spin-offs. We've distributed shares tax-free. Most of the things we do, we try and avoid those conglomerate discount things, and we really try and act like an anti-conglomerate. So well, I hope so.
You've done a remarkable job, and thank you for just living up to everything. We got behind you, and I said, we just got to get in on this, and I feel terrific about it, and it's going higher. Okay, I want to thank you to Joey Levin, who is the CEO of IAC, a company we have long liked, and I hope you now can understand it's very transparent. You can look at everything. Learn the division so you know what you're getting into. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.